Hi, I'm Andrew Allred, Vice President at Four Bridges Capital Advisors. Thank you for joining us in Part 12B of our video series on due diligence. So you've signed the letter of intent, and now the buyer wants to proceed into due diligence. If the letter of intent is the handshake, due diligence is the detailed process of allowing the buyer to dig deep. This is more than just popping the hood. This is a test drive and a detailed inspection of your business. A buyer's goals are to confirm the valuation, and your goals should be to avoid surprises and help the buyer gain confidence in buying your company. Today we're going to talk about what facets of your business a buyer will look into in the diligence process. We'll zoom in on the quality of earnings in particular, and then we'll end with some pro tips. So what's a buyer going to look at in the diligence process? Broadly speaking, there are several discrete work streams that a buyer will want to investigate. Typically, each of the following work streams will involve the buyer's own diligence alongside third-party diligence providers that they will bring into the process to assist them with their due diligence. First, a buyer will conduct financial due diligence, review of income statements, balance sheets, cash flow statements, accounts receivable aging, accounts payable aging, forecasts, and many other facets of financial diligence. From a legal perspective, a buyer will want to review all of your contracts, organizational documents, intellectual property, leases, pending and threatened litigation, and many, many other things. Another key work stream is tax and regulatory diligence. From a tax perspective, a buyer and their advisors will want to look at your tax returns, any compliance matters, and with regulation, you can get into industry-specific items that a buyer may want to evaluate as well. There's also a HR work stream. A buyer will want to look at your org chart. They'll want to look at your compensation plans. They'll want to look at employee turnover and any key agreements that you have with key personnel. A buyer will also want to look at your operations. They'll want to analyze what systems you're using to run your business, your ERP system, your financial system, your cybersecurity, your key vendors, any other aspects that touch operations and how that might integrate into a buyer's operations. They'll want to investigate. Finally, there are often ancillary work streams that are industry dependent. For example, a manufacturing business might have a heavier environmental diligence component, and a buyer might want to conduct a phase 1 or phase 2 environmental study on the property. There are also industry-specific licenses that come into play depending on the type of business. Now let's zoom in a little bit more on the financial work stream. Specifically, let's talk about a quality of earnings. In the vast majority of cases, a sophisticated buyer will commission a quality of earnings report. In many cases, they will bring in an outside accounting firm to conduct that quality of earnings. Typically, the buyer's quality of earnings provider will ask for your trial balances or general ledger and will in effect reconstruct your financials from the ground up. They will perform exercises like a proof of cash or a proof of revenue. They will analyze trends in your income statement and balance sheets. There will often be multiple phone calls and detailed list of questions that you'll be asked to answer. Critically, the quality of earnings will also evaluate any proposed EBITDA adjustments. The main goal of a quality of earnings is to ensure that the financials presented to the buyer are actually the financials that are uncovered as a part of the quality of earnings. It's your goal, alongside your advisor, to ensure that there are no surprises throughout the process of the quality of earnings. Sometimes, sellers might consider commissioning their own quality of earnings. We would call that a sell-side quality of earnings or sell-side Q of E. Your advisor should be able to help you determine whether or not this would be beneficial to you in your process. Last, a few pro tips. First and foremost, be organized. Have a data room that's ready to upload documents for the buyer in an organized fashion. Your advisor should help you with this. Second, be transparent. Disclose issues early and over-disclose. Surprises are not helpful for either side. Third, be patient. This is a long process. Diligence typically lasts 60 to 90 days. Think of your advisor as your air traffic controller. They can filter the noise for you and distill what's important. But even then, it might feel like you're being asked the same question 2 or 3 or even more times from the buyer's various diligence providers. Be patient and know that there is a finish line on the horizon. As a final word, the diligence process is long and arduous. Having an advisor in your court to help you navigate the process will increase the likelihood of a smooth, timely, and successful closing. We're here at Four Bridges Capital Advisors to help you throughout that process. Please don't hesitate to reach out with any questions.